Okay, good evening, class, and welcome to our taxation class. Sorry, the place where I am right now is very dark, and so you won't be seeing my face, but I'm happy you'll be seeing my notes, which is what matters right now. Okay, today we'll be talking about taxation of investment income. Okay, so let's get the rules in place before we start. We want to know that students are still required to put their device on mute so that there will be no noise coming from the background to interfere with the class. Also, all audios and all videos should be off so that we will all have a smooth class together. Okay, if you want to ask any question, use the chat button to ask the question. So let's get straight to the topic for today, which is taxation of investment income. The last class, I recall telling us that there are about three kinds of income that we will be talking about. The first one which we discussed was business income. Now, in business income, we look at the company, the sole proprietor, and partnership falls under business income. So as long as you are doing one form of business, selling or getting services rendered, and you're getting paid for that service or for that goods that you exchange for value, that will include an accountant who is also in his profession is any business income. Okay, then we said business income are usually treated on preceding year basis. So preceding year basis is the basis period for business income. We then mentioned that another kind of income is I said before we should not put our videos on, please. Thank you. Another kind of income is the employment income, which is what we did the last time. Employment income. In employment income, you get benefits which we call emoluments. So everything you get from being an employee falls under employment income. And we said employment income could include things like salary, wages, bonuses, commission, name them. We also talked about benefits in kind, housing, car, and all that you do not have in monetary value, in monetary terms, but the value is given in the form of tangible things. They are all benefits in kind. So all of these form your employment income as long as it is coming from your employer. And we said there are the two of them, the business income and the employment income, form what we call the end income, the income you earn. So if you don't work, that is, if you don't provide service or goods for sale of value, you will not earn business income. If you don't go to work, you will not get paid. So you will not get employment income. So both examples of earned income. I also mentioned that employment income is treated on actual year basis. I also remembered saying that we have unearned income. These are income that you do not earn by working every day. You just sit down and you start making money. These are passive income. You remember all these people who will tell you, please put in 20,000 naira in the next 45 minutes, you are going to get double of it. These are examples of unearned income. But I'm not saying you should go and invest in all these because some of them can be used for scamming purposes. But we're talking about legal investment income. So today our topic will be on investment income, also known as passive income, also known as earning money while you sleep. So what is the basis period for investment income? What are the allowable exempt? What are the income that are from investment that are exempt from tax? What are the allowable and disallowable expenses that are connected with this investment income? These are some of the things we are going to find out today. So many individuals, many taxpayers derive their income mainly from employment and trading or rendering service. That is from the end part of the income. Companies gain their income mainly by carrying on their business activities. However, a few individuals and businesses go away from their line of trade and business to earn income by making investments. So when you go away from what you are usually doing, that is not your line of business, you want to venture into investment, then that is investment income. Investment income are income received primarily from investment decisions. Okay, some of those decisions could include either buying of shares or selling of shares. Okay, could also be that you want to loan a company money by way of giving them long-term liability or maybe preference shares or bonds. So that way you are also lending and you'll be receiving interest. But when you buy shares, what you get is dividend. It could be that you built a house or perhaps you built a hostel. Let's use hostel for example. You built hostel in a strategic place, maybe near a school, and you put it on rent. People come in, rent it, and stay, and you are getting rental income. Or perhaps you go to the bank, the money banks, and you decide to put your cash on fixed deposits or any other thing that is going to yield interest to you. These are investment income. Even those people who did MMM, they are still doing investment income. As long as you are not doing any intentional, deliberate work regularly so as to earn income, you are just making your money work for you, not working to get paid. Now, these are investment income. We'll be looking at about four types of investment income, which are dividends, interest, rent, royalty. Okay, before we go into all of these, there is something interesting about this income: dividends, interest, rent, and royalty. I discovered that these are typical unearned income. They are withholding tax. The withholding tax on this income, whether as an individual or as a company, the withholding tax for all of them is 10%. So it means that when a company pays dividends to another company that would have bought a share, it will deduct 10% of what was accrued to the person who invested. If it is an individual who bought the shares, when the dividend is coming, 10% will go off. So it will be net of withholding tax. The same thing with rent, the same thing with interest. When you are receiving your interest, you get 10% off. So it is net withholding tax. So this is something interesting. So in case you are looking at withholding tax and you see company 10%, business and individuals 10%, those ones that both individuals and businesses are having 10%, these are the unearned income belonging to this group that we are talking about. Now let's look at the basis of assessment. The basis of assessment is the preceding year. It is the preceding year. So it means that in all the taxes we've discussed so far, it is only one that is on actual year basis, which is the pay as you earn employment income. Every other one that you are discussing at this level, if it is sole proprietorship, partnership, which are under direct assessment, these are based on preceding year basis. Then we are now talking about business income like company income tax, preceding year basis. We are also talking about investment income, preceding year basis. So let us now look at some investment income. This unearned income, that is investment income. Let's discuss about them for a moment. The first one we'll talk about is the dividend income. Dividend is that part of the profit that is distributed by a company to its shareholders in proportion of their respective shareholding. It means that if a company declares profit of 100 million, and if they have the, the policy of distributing 30% or let's say 40% of their profits as dividends, or let's be very conservative. Let's say they decide to use 20%, distribute 20% of their profit as dividends. It means that 80% of their profit is going to go to retained earnings. That means whatever they make by the company will plug back 80% into the business and give out 20% to the shareholders. That's part of the profits that they give to the shareholders is called a dividend. Now, the Personal Income Tax Act, CAP C21, Laws of the Federation of Nigeria 2004 as amended, defines dividends as in relation to a company not being in the process of being wound up or liquidated. What does that mean? Any company that is not in its penultimate year or ultimate year. Because as if you are in your penultimate year or ultimate year, so to speak, that means you are in the process of being liquidated or you are being wound up, winding up. Any company that is not being liquidated, dividend to them means any profit distributed, whether such profits are of a capital nature or not, including an amount equal to the nominal value of bonus share, debentures, securities awarded to the shareholder. So It means that when they give you a bonus share, it is classified as your dividend. So instead of giving you cash as your dividend, they could decide to give you a bonus share. So it means that they have increased your shares, but it's part of your earnings. Okay, they said whether it is a capital nature or not, as long as it is from profits, that it is going out from a company, from their profit to any other person. And that company that is giving out that thing is not about to wind up that dividends. B, in relation that to a company that is being wound up or liquidated, any profit distributed, whether in money or money's worth or otherwise, other than those of a capital nature earned before or during the winding up or liquidation. So anything that you are giving out, that you are earning, that you earn before the winding up or liquidation. That means when you are liquidating, you are not expected to be sharing dividends. You are not expected to be sharing dividends because you are supposed to be liquidating your assets. You are supposed to be, paying your liabilities. So you're not supposed to be sharing dividends. So we look at the Nigerian dividends. What do we term a Nigerian dividend? The income from dividends distributed by a Nigerian company. Any dividend that is being distributed by a Nigerian company is termed Nigerian dividends. Now let me give you an example. Now, if you buy a share from a company that was incorporated in Nigeria, the company is giving out dividends. That dividend is a Nigerian dividend. If you buy a share from a company that is not incorporated in Nigeria by Kama, even though the company is situated in Nigeria, that dividend is not a Nigerian dividend because the company is not a Nigerian company. What makes a company to be Nigerian or foreign is the incorporation. So what makes a Nigerian company is if it is incorporated in Nigeria. So let's continue. Now, a company that is a Nigerian company is giving out dividends to any shareholder. Now, the dividend shall be the gross amount of that dividend before any deduction of tax, which the company is required to deduct on payment thereof under the provisions of any force in Nigeria at the relevant time imposing taxation on the profit of that company. What does this place mean? It means that when a Nigerian company is paying out dividends, let's say, let me use an example, First Choice Accurate Limited is a Nigerian company, and let's say we have 11 students here in taxation. We are all 11 shareholders. If the company is paying, let's say, a dividend to, let's say, Kindness, Obiokwe, let's say Kindness is a shareholder. Let's say Kindness has 100 shares or maybe 1,000 shares in FCA, and the money that is supposed to go to her is, let's say, 100,000 naira. That is the gross amount that should go to her. It means when Kindness is reporting her dividends in her books, she is going to be reporting the gross amount that is due her. Even though she did not get the gross, what you got was the net. But what you report is the gross. Now, the company that is paying you the dividend is required by law to deduct that 10% from the gross. So they are paying Kindness 100,000 naira. They deduct 10%, which is 10,000 naira, and they paid her 90,000 naira. So Kindness will not just say, oh, my dividend is 90,000 naira. No, your dividend, Kindness, is 100,000, even though you receive 90. You will report it as gross and recognize the fact that withholding tax of 10% has been deducted. That is the deduction of the tax that is being said here. The income from a dividend distributed by a Nigerian company shall be deemed to arise on the day on which payment of that dividend becomes due. So when a dividend becomes due to be paid, then it shall be deemed to arise on that day. All right, now let's go further. We say territory in which dividends paid by a Nigerian company arise. Now this is territory in which dividends paid by a Nigerian company arises. Where a dividend is distributed or paid by a Nigerian company, the dividend, whenever necessary, shall be deemed to be derived from the territory in which the recipient of the dividend resides. Let's take it again. Where a dividend is distributed or paid by a Nigerian company, the dividend shall be deemed to be derived from the territory in which the recipient of the dividend resides. You know, we learned about the place of residence, and we said for an unearned income, your principal place of residence, if you are having unearned income, which is investment income like dividends, your place of residence is where you usually reside. And so we are now seeing it clearly here that when you receive dividends, it is deemed to come from where the person resides. Let's take, for example, Kindness. This is an assumed location. Let's say Kindness is based in Imo State and FCA is in Lagos. And so Kindness now receives dividends from FCA. Now, it is deemed that the dividends that Kindness received is derived from Imo State, even though it is derived by FCA in Lagos. So that is how it is. That would mean that the withholding tax that is deducted on Kindness's dividends will go to that place, that tax authority that covers where Kindness is deemed to be resident. All right. Now it says where the recipient is not resident in Nigeria, where the recipient is not resident in Nigeria, the person shall be deemed to be a person resident outside Nigeria. So if you are earning an investment income from a Nigerian company, but you are not resident in Nigeria, that means you are not living in Nigeria for up to 183 days and all that, then you shall be deemed to be a non-resident person who derives income or profit in Nigeria. And so the dividends by a non-resident person is deemed to be derived from the Federal Capital Territory. So what does it mean here? It means that if a diplomatic, it's not a diplomat, sorry, if a diplomatic agent, yes, from another country, let's say from Ghana, that is in Nigeria, let's say a Ghana High Commissioner in Nigeria. That person, even though he is living in Nigeria, let's say in Abuja or perhaps in Lagos, the person is seen as a non-resident because he is a member of a diplomatic agent of another country in Nigeria. So he's not seen as resident. So he is deemed to derive his investment income from the Federal Capital Territory. Okay, what if the person is an expatriate who does not stay in Nigeria, he comes here, does not stay up to 183 days, and let's say the person is working in Port Harcourt, receiving his salary there, but he doesn't stay up to 183 days, then he's not a resident person. So what happens to him? He is seeing that any investment he makes in Nigeria is coming from the Federal Capital Territory. So you see how investment income works, dividend. So because the dividend is not something you must work as you do business income or employment income, where it is seen to be derived from where your office is or where your place of business is. Investment income is just sleep and the money comes into your pocket. And so the recipient of that investment income is deemed to have derived that income from where the recipients reside. Okay, so even though you buy your shares, you let's say let me say Funke. Let's assume that Funke is in Ogun State and he buys shares in Lagos, a company in Lagos, let's say GT Bank or Sterling Bank, Marina, their head office is at Marina, and you buy your shares from Sterling Bank and they are paying dividends. The dividend is seen to be derived from Ogun State. Okay, what about dividends exempt from tax? Now, how come dividends will be exempted from tax? And we are talking about taxation of investment income. And dividends is an investment income. How come dividends will be exempted from tax? The following dividend income are exempted from tax. One, dividends in from abroad and brought into Nigeria by a Nigerian resident in a convertible currency and paid into a domiciliary account in a bank approved by the government. So that means if you earn a foreign dividends. We said Nigerian dividend. What is Nigerian dividend? We said a Nigerian dividend is any dividend distributed by a Nigerian company. Okay. So, but this one here is any dividends earned from abroad. So, it could be a Nigerian company that is in abroad. Let's give an example. Let's say Glo Nigeria is a Nigerian company, but Glo may be having a branch in South Africa, and they may also have investment in South African currency, the rand. And somebody who is a Nigerian resident, because we know what a Nigerian resident is, happen to buy that buy shares from Glo South Africa, and now they pay him dividends, and that dividend is brought into Nigeria in convertible currency. So that means the currency in which they pay to him can be converted, and it is paid into an account in Nigeria. approved by the government. That foreign dividend, that dividend in abroad is not taxable. It is. So now, can you see now the difference now? The difference here is that in Nigerian dividends, anywhere you are in Nigeria, that is where it is deemed to be, you are deemed to be resident, except if you are a non-resident who earn a Nigerian dividend. But now you are earning a foreign dividend abroad. So normally, this is not Nigerian dividend. And so that law does not come into place where you are in Nigeria, you be seen as being derived from Nigeria. No. So it is derived from abroad this time, but brought into Nigeria and put in an approved bank that is exempt. Dividend distributed by unit trusts is exempt. Dividend received from small companies in the manufacturing sector in the first 5 years of their operation. So it means that if you are looking at a company who is manufacturing and they are in their first 5 years, that means if you are doing commencement rule for any manufacturing company that is deemed small company. So now the problem is, what do we look at as small companies? Okay, if we go by what the um, new Finance Act says, a small company is a company that is less than 25 million. But you know, the CAC also have their definition of what a small company is. So, but plans are underway to harmonize the two of them so that it will read as one. So, but for now, a small company is a small company. Okay? If the company is a manufacturing company, in the first 5 years, any dividend it received, any dividend that they share, any dividend they share to shareholders is exempted from tax. So if you see a question and they say that dividends from small company, that dividend is exempt from tax. Now, dividends received from investment in wholly exported oriented business. So if you invest in exports business, if you're into exports and um, some people invest in your company and you're not paying them dividends, that dividend will not be subject to tax. Now, dividends received from a pioneer company, which is paid from profits exempt from tax, and dividends is distributed by a gas utilization company during its tax-free period. So, all right, another one is dividend distributed by a Nigerian company by way of bonus shares. So it means that if you want to avoid tax, instead of giving your dividend by way of cash, you can give them by way of bonus shares. That way, you avoid them paying tax. So these are exempted from tax. Okay, we now come to what we call franked investment income. What are franked investment income? Any dividend received by a company after the deduction of withholding tax at source is seen as franked investment income in the case of receiving the company receiving the dividends. Okay, now look at it. Any dividend that is received by a company after the deduction of withholding tax at source, of course, that 10% would have gone off. That means the 90% that is being paid to you is regarded as franked investment income in the hands of the company receiving the dividend. Such income is not subjected to further tax in the hands of the receiving company. That means when Kindness Limited receives a dividend, 100,000 is the 200, so let's say 100,000 is the gross, but she receives 90,000. Okay, sorry, 900,000. 100,000 is the gross. She now received 90,000. Yes, it means that the 90,000 is not subjected to further tax. This means that the only tax suffered by a franked investment income is the withholding tax. And as such, the dividend should be excluded from the total profits of the receiving company before computing the income tax. What does this mean? It means that when you are computing tax of a company and you are bringing their income from all sources, you will mention the dividend income that the company receives. Under the income section, business income is there, and maybe investment income now puts dividends. What does that mean? It means you record the gross dividends that that is accrued to you. After recording the gross dividend accrued to you, of course you know there's 90% that came to you, and you have your total gross dividend. You will still deduct that dividend that came to you again in full. Why? Because it is not supposed to be subjected to further tax. So to make it exempt from further tax, you also less it from your gross income. That way, the dividend will not suffer another tax because it has already suffered 10% tax. Okay? In a situation where the receiving company has collected dividends and then redistributes it to its own shareholders, the company has the right to withhold tax from the redistributed dividends and then use it to offset the withholding tax that the frank investment income has suffered. This helps in preventing double taxation. So what it means is this: Kindness has received 90,000 naira, which is not subjected to further tax, and it is going to now pay shareholders that have invested in Kindness Limited. Okay, and part of the dividend that Kindness is paying to the shareholders is the one that she collected from, let's say, FCA. That means she collects from FCA, she's not supposed to subject it to further tax, and she is redistributing it. Kindness has the right to withhold that 10% that she is going to, yes, collect from those people who have suffered withholding tax by way of dividend by into Kindness Limited. And so when she collects that withholding tax, she's going to use it to offset whatever she has suffered so that it prevents double taxation. Because now that dividend has suffered tax before and it is now going to be redistributed. So by collecting the withholding tax, you have counteracted the effect of that one that was suffered before. So that it's only once that the final people who are going to receive that dividend will suffer just one tax. Okay, we are going to see a question where we use that analogy whereby you redistribute your dividends and the dividend is being offsetted. The dividends withholding tax is being offsetted. Okay. We'll now look at question number 1. In 2000, Tata Limited received a net dividend of 180,000 after the deduction of 10% withholding tax. Now, what does that mean? This is a net dividend of 180,000. So, can you calculate the gross for me? If you are given a net of 180, how do you calculate the gross? It means that this 180 happens to be 90% of the gross. How do you get the whole 100%? What you simply do is 180 divided by 90 multiplied by 100. It's as good as saying 180 divided by 90 and by 0.9. I take it again. If you are giving a dividend, a net dividend, and you want to find the gross, you simply say the net dividend divided by 0.5, 0.9. That will give you the gross. If you are given a gross and you want to find the net, what do? You do the opposite. You will say the gross multiplied by 0.9. That is, if you are giving gross, you want to get net. If you are giving net and you want to get gross, it is net divided by 0.9. It gives you gross. During the accounting year ended 31st December 2000, it made a total assessable profit of 2,850,000 naira, which includes the gross dividends received. What does it mean? It means part of the 2,850,000 naira it has includes whatever is a gross that the 180 gives to you. So can we do it now and tell me in the chat room what the gross of 180,000 will give us? Please, let's do that for the next 1 minute before we continue. What is the gross of 180? For those of you who said 200,000, you are correct. Somebody said it's 2 million. And somebody did not put comma, so I don't know whether you are putting 2 million or 200,000. So please be putting comma so that comma will not make you fail the answer. So it's 200,000. Okay? Thank you. Thank you for all those who participated. 200,000 is the gross. Now, it is saying that part of the assessable profit that it got for the year, including that 200,000 from dividends, is what makes up 2,850. That would mean that it got 2,650,000 separately and 200 separately. When you join them together, it became 2,850. In the same year, the company company paid a gross dividend of how much? 700,000. Now, mind you, it had 200 dividends received, and now they are paying how much? 700,000 naira dividend to each shareholder, including how much? 140,000 of the dividends received. So it means they received 200, but they are distributing 140. They are distributing 140 out of the 200. So it means that inside this 700 that they are giving out to their own shareholders, 140 out of it is redistribution from the 200 they received. That means 560,000 is fresh from what they made from their own company. Required, compute the company's tax payable on the company's profit. So let's see how we can solve that in a moment. Okay, so now let's see the solution here. Now the solution is this. Accessible profit, which includes the gross dividends, is 2,850,000. Now this 2,850,000 is including the dividends, and we are saying that dividends received by a Nigerian company is from another Nigerian company is not subjected to further tax. That would mean that 200,000 that was included here will now have to be deducted. When you deduct it, you are having a taxable profit of 2,650,000. It is from this 2,650,000 that you will pay your tax of 30%. So that is the answer for the first part. The 200 should not be part of what is to be taxable. B part, compute the withholding tax due from the company. What this question is saying is, how much withholding tax will you pay to the government? What you look at it is this. You suffer withholding tax when you got this 180. In fact, when they paid you the 200, you suffered withholding tax. Now you are paying 700. You are going to charge withholding tax on all these 700. Part of this 700 for 140 that was redistributed, you are regaining whatever you suffered from the 200. So it means that the net that you are going to be withholding is 560, which is what you are going to share and give to the government. So let's see how the solution is. Withholding tax payable on distribution of dividends. It means this is the dividends that you are giving to your people. You are going to collect withholding tax 10%, which is 70,000. Now the one you suffered before, the 200,000 you suffered before, because you are redistributing 140, the 10% of it is a recovery of what you suffered. So you have recovered 14,000. That would mean that the remaining 560, 10% of 560, which is 56,000, is what you will be paying to the tax authority. Okay, so can you please give me like 2 minutes? Just a moment, 2 minutes. Welcome back. Now we've seen dividend income. We've seen that dividend income are only allowed to suffer withholding tax, and that is the final tax that is sufferable by dividend income. And if you are redistributing it, you are allowed to recover whatever withholding tax that you suffered. And so the net is what is being payable to the government. We've seen the withholding tax and the dividend income that are exempt from tax. Let's take the second investment income, which is interest income. Okay, the interest from any interest on money, the income from any interest on money lent by an individual or executor or trustee outside Nigeria to a person in Nigeria, including a person who is resident or present in Nigeria at the time of the loan, shall be deemed to be derived from Nigeria if there is a liability to payment in Nigeria in the interest, regardless of what form the payment takes and wherever the payment is made. The interest accrues in Nigeria to foreign company. The interest accrues in Nigeria to foreign company or persons, regardless of what form the payment takes and wherever the payment is made. So we are seeing that these are some of the interest income that is subjected to tax. So any interest on money you lend to people, any interest on money you lend to anybody is taxable. That's investment income. Interest from a source outside Nigeria. When an individual is resident in Nigeria, the interest accruing to him from a source outside Nigeria is liable to tax in Nigeria if such amount of interest is brought into or received in Nigeria, subject to double taxation provisions if possible. Okay, territories in which interest paid by Nigerian company arise. Where interest is paid by a Nigerian company, the interest, whenever necessary, shall be deemed to be derived from a territory in which the recipient resides. Or if the person is not a resident person, is deemed to be derived from the Federal Capital Territory. This is exactly what we said when we discussed the dividend income. Now look at some of the interest income that are exempted from tax. The following interest incomes are exempted from tax. Interest accruing to the person on foreign currency domiciliary account. So if you have a foreign currency domiciliary account, any interest that you are accruing there is not taxable. With effect from January 1, 1996, 100% of certain foreign income are exempted from tax, provided that such income are repatriated into Nigeria in convertible currency and paid into a domiciliary account in a bank approved by government. Income falling into this category includes interest in from abroad and brought into Nigeria by a Nigerian resident. Now, this is a replica of what we saw in dividend income. Interest accruing to a person who is not resident in Nigeria as specified below. The interest on a loan charged on public revenue of the Federation and raised in the United Kingdom. the interest on bond issued by the government of the Federation to secure repayment of loan raised from International Bank for Reconstruction and Development under the authority of the Railway Loan Act. Interest on money borrowed by the government of the Federation or of a state in which includes the exemption of interest from tax in the hands of non-resident persons, and the list goes on. So some of these are interests that are exempted from tax. Another one is agricultural trade or business. So any interest on agricultural trade or business is exempted from tax. So one thing I want to say about dividend income and interest income is that the final tax that these two incomes suffer is withholding tax. Withholding tax is the final tax suffered by anyone who invests in a business and they paying dividends, or who lends money and is receiving interest. Okay, so whatever treatment we've done for dividends, we'll do similar. So when you are seeing interest income not subjected to further tax, you see we do the same thing we do for dividends. Now let's look at rental income. Rental income, the gain or profit arising from another person for the use or occupation of any property is chargeable to tax. So when you rent a house, you rent an office, you rent a machine, you are paying rental income. That income that is derived from leasing, renting, is called a rental income. If rent is received in advance, it will be spread over the period of the rent, provided the period is not more than 5 years. So if you receive 2 years or 3 years rent in advance, it will be spread over the period of the years. And of course, the tax will be deducted and charged to those years. So far, it is not more than 5 years. However, if rent received in advance covers a period that is more than 5 years, it will be spread for 5 years. So it means that you cannot pay rental tax on you cannot pay tax on rental income for more than 5 years in advance. So it means that if you receive for 10 years, your tax authority will take it as if you have received for 5 years and will charge you the tax for 5 years. It means that for the other 5 years, after the first 5 years, the tax authority is not seeing you as collecting rent. So they want to collect their money quickly, so they charge you for 5 years. Thus, for tax purposes, the gain or profit arising from rent of a property is ascertained by deducting only those expenses that were directly incurred for the purpose of earning the income. And what it means is that when you collect rent, let's say in Lagos, you stay in a place where you collect a rent of 800,000. There are certain things that you would have incurred. Those expenses you incur solely because you want to earn that income. These are called allowable rental income. Allowable rental expenses, rather. It is those expenses that you must deduct to the income that you received. What are some of these? One of them is called the tenement rates or the land use charge. The tenement rate or the land use charge, because you are renting that a house and you are making money, you pay tenement rates, you also pay land use charge. You are free to deduct this money you paid for those things for because these are allowable expenses. Okay, cost of collecting rent. Maybe you pay a caretaker, you're not living there, you pay a caretaker to be collecting the rent, or you have a lawyer who is collecting it for you. Anything you pay him, his fees should be deducted because without the lawyers doing his job, that rental income may not be achieved. So you deduct his fees because it enables you to earn that income. If you advertise for tenants to come, maybe all the cost you spend in advertising on newspaper, radio, even on Facebook, you put Facebook ad and all that, the cost of advert, and people saw your house and they fell in love with it and came to rent it, it's going to be deducted. Any expenses incurred for repairs and maintenance of the building. So if you make any repairs or maintenance of the building, as long as the part you are maintaining is not the part that is occupied by you, the landlord. Because you, the landlord, you are not making profit from yourself. You are earning income not from yourself, but from your tenants. And so it means you are going to deduct whatever expenses you spend maintaining your own side of the building. Only those side of the building that belongs to the tenants are the parts that is involved. Okay, bad debt incurred. You know, how do we have bad debt? Bad debt might come as a result of, okay, you give somebody quick notice, and the person drags you to court and the person is owing you 2 years, 3 years, at the end the person didn't pay. That's a bad debt. It's going to be deducted because that is a loss of revenue for you, and so you're not going to be charged on those bad debts. Okay, interest on money borrowed and employed in acquiring or renovating the property. Now, take note, the money you borrowed to renovate the property is a capital investment. If you are paying back the money, it's also a capital investment. We are talking about the interest on the money you borrowed from bank. That money you borrow from bank just to renovate the property that you are putting for let, that interest is allowable. Commission you pay to your agent or caretaker cost, then any insurance premium paid on the property. Then we have water rates. Okay, so all these are some of the things that are allowable. What are some of the disallowable? Any expense that is not incurred for the purpose of any rental income is disallowed. So it includes that the part that the landlord is staying, any expense incurred for its maintenance of it is not allowed. Except, of course, if the landlord is going to say that he's going to be paying his own rent too on a fair basis. He takes it from his income. But I wonder, you can't be paying rent to yourself. In one hand, you are paying rent, in the other hand, you are receiving it. So the landlord's area is going to be deducted. It's not incurred for the purpose of rental income. Any expense nature of a capital nature. So when you are renovating your building, it's seen as a capital nature. When you are painting your building, painting is seen as a capital expenditure. Forget the fact that the cost of painting may be small, but when you paint, you don't paint every year. Some people don't paint every year. So if you have the habit of painting every year, then you can see it as an operational expenditure. But if you don't paint every year, then painting is a capital nature. Depreciation of the building is not allowed. And appropriation of profits, that means when you are sharing profit, including income tax, drawings, and reserves, these are not allowed. Let's look at question number 2. Okay, I think question number 2. Mr. Jayesimi owns a property located at Glover Road, Lagos. He declared his rental income for the year ended December 31, 1996 as follows. Now take note, this is a person, and so every individual, the account year end is 31st December, is following government fiscal year. But because this is an investment income, it is charged at preceding year basis. So it means that it is in 1997 that he will be paying his tax. Now look at the gross amount received. Now look at it. Rent received. If the question does not tell you it is gross, assume that it is gross. If the question does not tell you it is gross, assume it is gross. Except if the question tells you it is net. If the question tells you it is net, then convert it to gross. Now, in the case of dividends and interest, if the question is silent as to whether it is gross or net, what do you assume? You assume it is net, because we want to assume that the company paying you the dividend will obey the law by deducting 10% withholding tax. And so they will never give you a gross. So the dividend, assume net, except if the question says it is gross. But for rent, assume it is gross, except the question tells you it is net. So now the question has told us this is gross, that's fine, 170,000. They now deducted expenses. Now, on the surface, all these expenses are allowable: water rate, tenement rate, caretaker's wages, repairs, electricity, this depreciation, except depreciation. Now, if you look at it now, depreciation is a disallowed expenditure. But we need to look at electricity. What does it contain? If it contains the part that the landlord is staying, that part will be deducted. The same thing with repairs. Okay, so we'll be looking at the expenses. They said you are supplied with the following information. We are told that capital allowance is granted for 1997 year of assessment. That shows you it's 1997 year of assessment we are doing. The building is subjected to capital allowance, of course, is 7,200. That's fine. That one will be deducted from assessable profits to get total profit. We are now saying that included in electricity bill, something is included. What is that? was 12,000 naira relating to the lighting of the landlord's flat. The landlord's flat is not expensed for the purpose of any profit. It's for his personal enjoyment. And so this 12,000 was not incurred necessarily for business. So it got to be deducted from the electricity bill. And how much was the electricity bill? It is 32,000, 1/4. So it deducts this, how much? 12,000 naira for it. Included in repairs were what? Extension to the property. Is that a capital expenditure? Yes. So we are extending the property. It is capital by nature. So we deduct this 5,400 from what was in repairs. Painting of flats not occupied by the landlord. So the painting here, painting is a capital expenditure. So whether it is occupied by the landlord or not, normally if it is an expense that is not occupied by the landlord, it should be allowed. But this is painting. They don't paint every year. So this is capital nature. New drainage. New drainage is also a capital expense. So all of these are supposed to be deducted from the repairs figure. Okay, part of water rate bills of 2,400 was for the taxpayers' flat. It means that for the water bill that they paid, 2,400 K, it's relating to where the landlord, who is a taxpayer, is living. So we need to deduct that 2,400 so that we will get the true nature. We are told to compute the amount of rental income in which the taxpayer should be assessed to tax for the assessment year 1997. And look at the answer to that question. Solution here, we have the net income or net rent that the man declared, which is this figure. This is the net rent that was declared. Now, let's add back all those things that are not allowed. First one is water rates. That's 2,400,000 that belongs to the landlord's flat. Look at the extension to the property. Drainage. Okay, in this aspect here, why painting of the building is the painting of the flat not occupied by the landlord is allowed could be because the painting is seen as an operational expense. So you see, it is what it was not added. The next one is electricity, the part that belongs to the landlord, the 12,000 naira part is added. Then we have the depreciation, we add it back. When you add all of these, you are having 35,770, which when you add it to 71,530, you have 107,300. That is your accessible rental income. But of course, the question said you have a capital allowance of 7,200. So you need to deduct the capital allowance from the accessible rental income. That means the taxable rental income is going to be 100,000. That is the rental income that should be subjected to tax, not the 71,530 that the taxpayer brought. So just give me another 1 or 2 minutes, then we'll go to the royalty income. Let's get to royalty income. Royalty income is a payment to an owner for the use of property, especially patents, copyrighted works, franchise, or natural resources. Let's give an example. Let's say a Nigerian artist, let's say Two-Face. He released his music, and let's say when he was still under Kenny's Music, and Kenny's Music is producing his music and is selling it. Two-Face will just sing once and you'll be paid over and over again. That is an investment income. But how much they are paying him? What are they calling it? He didn't buy shares by singing. Neither did he lend maybe Kenny's Music any money for doing business. What Kenny's Music is doing is they are making business by promoting Two-Face's music. And so they are using Two-Face's natural resources, they are using his talents, they are using his works. And so they got to pay him a royalty. And so they have to compensate the owner for the use of his assets. That's the royalty. Royalties are always often expressed as percentage of the revenue. So when we say royalty, it's not expressed in figure, it's going to be expressed in percentage. You can say royalty of 10 or 20% of the revenue. So whenever you make anything, any revenue you make from using my intellectual property, give me 20% as royalty. So it's expressed in percentage. Royalty exempted from taxation. Royalty brought in from abroad and brought into Nigeria shall be exempted from tax, provided it is brought into convertible currency and paid into domiciliary account in the bank approved by the government. So you see all of them are giving almost the same thing. Now let's look at this example here. Although this example does not depict royalty, but this example here is an example showing you the three kinds of income that I mentioned. We have the employment income, we have the business income, and we have the investment income all here. Mr. Deboye is a top business executive who is nearing his retirement age. He has therefore decided, okay, now the part is business executive. That means he may be working somewhere where they are paying him salary, because he also see retirement age. That means he must be receiving income subject to personal income tax. He now decided to run a petty business. Now that means he is not the owner of this business, so he's employed by somebody, because somebody could be a business executive and be the boss. And so if he's the boss, he's not going to subject to pay. Now he tried to decide to run a petty business in addition to some investment in shares of some reputable companies. Now the following information is given by Mr. Adeboye. Look at the basic salary he got in 2011. Then in 2012, he must have received either increment or bonus. In 2013, perhaps, who knows, because he's a business executive, he must have received some benefit in kind. Okay, some pay raise. All this maybe could be pay raise, yes, basic salary, pay raise, and all that. We then have business income. You see for 211, 212, or 213. Now, why are they giving us 211, 212, 213, and the same here? So if they do that, you need to separate them accordingly. Now, how do you do it? Look at investment income for the 3 years also. Now, the thing is, if you are to do for 2012 tax year, if you are to do for 2012 tax year, basic employment income will be on actual year basis, which is going to be 3,900,000 actual year basis, because you are doing for 212. Business income will be at preceding year basis. So it means that for 212, we'll be looking at an account in 211. And for dividend income, you will also be looking for an account in 211. That becomes your taxable dividend income in 212 year of assessment. Now, what about this productivity bonus? Where is this bonus coming from? From employment. So if you are doing 212, you look at anything that has to do with the actual year. Now look at rent. This is another investment income. So interesting thing here is they give you from January 1 to 11 to 31st December 2013, which is 3 years, and they give you the lump figure for the 3 years. So if you are doing it, we said as long as rent is not more than 5 years, it will be spread throughout the 3 years they give you. So it means you have to divide the 3,600,000 by 3 to get 1,200,000, which you will use for each year. He now said that Mr. Adeboye has 6 children, all of whom are in secondary school. That is just to tell you that he qualifies for CRA. Whether he has children or not, he qualifies for CRA. So that is of no importance. This information number 5 or 6 is not important. Capital allowance relating to the business is 36. So this one will have to be deducted from the business income to get the net of profit. Then Mr. Adeboye has the life insurance policy with capital sum assured is 5 million. This is not important to us, but the annual premium is important to us. So this is important as a deductible expense because it's a person. Mr. Adeboye contributed this amount to a National Housing Fund and this amount to a pension fund respectively. That's allowed. His age parents who have no income, he has age parents who have no income of their right. That is not important to us because he has been granted CRA. We are told to compute the income tax payable by Mr. Adeboye for what year? As if I guessed it, 2012 year of assessment. We've done a lot of analysis in that 2012. Let's do that analysis again. Okay. Now let's do that analysis again. Okay. The first thing to do here is to compute his income for 2012 income tax. Employment income, we know it's actual year basis. So his salary for 2012 will be given, his productivity bonus for 2012 will be given. So what is it there? Salary for 2012 is 3,900,000. What about the productivity bonus? You give also for 2012 240. So that's what we have here. 39 and 240 gives you 4,140,000. That's your employment income for the year. We now go to business income. We know it's preceding year. We are told to use 2011 on, which is 3,300,000, sorry, which is 5,400,000. So that's what we are using, less any capital allowance. So we look at our business, there is a capital allowance of 360,000. So we use that capital allowance to relieve our business income. And that gives us this figure. That's not all. We now look at investment income. Since investment income is on preceding year basis, we look for the one that has to do with 2011. I told you if dividend is given to you, I didn't tell you gross, assume it is net. So look for the net of 30, sorry, look for the gross of 30, gross for 50, gross for 40, add them together. Let's see, 50 plus 40 is 90, 90 plus 30 is 120. Look for the gross of it. But in this example, I tried to do them separately. Look for the gross of this, 30,000 gives you this. Look for the gross of 50,000 gives you this. Look for the gross of 40,000 give you this. And when you now added that of rent, and I told you if rent is not told, assume it is gross already. So this was 3 million, we divided it into 3 parts because it's 3 years and each of them is 1,200,000. Okay, now you add everything together, you have 1,333,333. These are when you add your investment income to your business income and your employment income, all you have now is 10,513,333. So what's the next thing we do? The next thing we do is to remove those income that are not subject to further tax. One of them there is the dividend income. So this dividend that we have calculated as 133,333, the gross, we are going to deduct it again. So it brings it to gross dividend less frank investment income. It gives us this 10,380,000. Out of which we decide to remove the reliefs. This is the 200,000. This is the CRA 200,000 plus 20% of your gross income. Okay, then your life assurance premium, your national housing fund, and your pension fund are all allowable. You add them and you get this 2,842,667. This is your allowable relief. You less it from your 10,380,000, you have taxable income of 7,537,333. So it is from there you have to calculate your tax. Of course, this is more than 3,200,000. So I told you if it is more than 3,200,000, as a trick for the exam, just start with first down to the next 6,000 at 1,600,000, right? At 21% and call it 336. Every of these tax altogether is 560. So when you are not doing the last one, you use the taxable income and minus 3,200,000 to get what we are going to use as the balance for 24%, and that gives you 1,040,960 naira. So that's your tax payable. Okay. Now look at Mr. Chukwuemeka Okoye is earning, this is rental income. Once again, this is a rental income. He completed the construction of his building, a 2-wing duplex in Gwagwalada, Abuja on 31st December 2011. He rented out both flats with effect from January 1 to 12 through an estate agent and received 2 years rent. Of course, the 2 years rent will be spread in 2 years. He made the following details available. Look at all the details. All right. Capital allowance are all stated there. Now, requirements. Compute the amount of accessible income, rental income accessible for tax. What happened is that okay, hold on. What happened here is that this is years of assessment that they give us here, because this is supposed to be years of assessment, right? Okay. And these are the information that they gave us according to the years of assessment. Okay. And these are the computation. Look at the rent received. Look at the allowable expenses. Repairs of tenant's bathroom. Repairs of tenant's bathroom is not here. I believe it will be in the additional information. Repairs and maintenance comprise of how many? Look at it. Repairs and maintenance. So this 220 and 450. Look at their components. Look at what gave rise to it. This is 220. This is about 450. So repairs of tenant's bathroom, allowed or disallowed? Allowed. Depreciation, disallowed. Repairs of Mr. Chukwuemeka's residence, disallowed, because you cannot be repairing your own residence and earning income. So it's only this first one that is gone, repairs of tenant's bathroom and 180 and 0. Then there's water rate. Water rate. Is there any information on water rate? There is no other information on water rate, additional information. So we take the water rate the way it was given to us. The next one is agent's commission, and there is no information about it. So we take what was given to us. Then we have professional charges, no information on that. Insurance, no information on that. Caretaker wages, there should be information on that. Caretaker wages 18 and 22. So let's see what caretaker will be saying. Okay, there's no information 1822. Tenement rate, that is where we might look at it now. Tenement rate includes tenement rate of 5,000 and 12,000 paid on the private residence of Mr. Chukwuemeka. So this 5,000 will be deducted from 25,000 tenement rate to give you 20. And this 12,000 will be deducted from 32,000 to give you 20,000. And there we have it. 20,000, 20,000. There we have it. So we've done everything. All you need to do is bring all your allowable expense, total them together, and deduct it from the rent received. That means your accessible profit is smaller and you've made it become. And now look at the capital allowances that you're charging from the accessible profit to give you the chargeable rents. So the next one, which is the final one, is Nelson and Sons Limited Ownership Company. It's a company owned by members of the Nelson family. It issues shares of 20 million naira, ordinary shares of 1 naira each, held by William Nelson, Samuel Nelson, Tamara Nelson, and Neil Malia Nelson. If you add all these shares, gives you 20 million ordinary shares. All right, for the year ended 31st December 2012, the company made a net profit before tax of 53 million. The company has not paid dividends since it was established 8 years ago. The Federal Inland Revenue is of the opinion that the non-payment of dividend by the company was with a view to reducing the tax payable by its shareholders. In exercising the powers conferred on it by the Companies Income Tax Act, the FIRS has directed that 15,900,000 of the profits be treated as having been distributed as dividend. That is what the tax people is saying. Compute the amount deemed to be income in the hands of the company shareholder. So they are telling you that forget about what these people have done here, 15,900 as profits to be treated as dividends. We are going to look for our own income in the hands of shareholders. Now, look at the shareholders. This Williams in 8,000 shares. When you divide it by 20,000 or 20 million, he owns a particular percent. Times it by the 15,950,000. That is the income, the dividend tax on it. So it means here 8 over 20 is 8 over 20 million to give you the percentage multiplied by the 15,900. Where did we get it? 15,900 was given in the question. This is the 15,900 was given in the question. So you use it. So that's how you keep doing everything. The number of shares of each shareholder divided by the total number of shares multiplied by the dividends that is supposed to be paid by the FIRS, that they have directed that. That would mean that the dividend supposed to be paid is 15,900,000, and this is how the shareholders are supposed to be receiving their dividends. This is the dividend they're supposed to be receiving. And you look for the appropriate tax on each of their deemed dividends. So the appropriate tax will be the 30%, and not 30%, first 300,000, second 300 is the pay scheme. So at the end of this lecture, we have seen dividend interest and rent and royalty. All these are unearned interest. I told you one interesting thing about them is all of them have a withholding tax of 10%, both for individuals and for companies. And that dividends and interest alone, the withholding tax for them is the final tax they suffer. It's not so for rent and royalty. And we've seen that for investment income, the basis period is the preceding year. Okay, and we've seen the income exempted from tax. We've seen the allowable and disallowable expenses. So all I want you to do now for me is to go back again, read this note, ask any question. I'll be glad to answer you when you come knocking. So until then, I want you to keep studying. The exam is just a 7 days time. So keep practicing, 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 and you will succeed. Thank you so much for coming to class today. And we hope that you have enjoyed the program today. Feel free to join us again for the very last time when we'll be having tasks on Saturday. And I will share some exam tips with you by that Saturday. Somebody was saying, can we get a soft copy of the lecture? If you are in the refresher group, the soft copy has been posted to the refresher group. So I've posted the material, so feel free to go and check it again. So do have a nice day and keep studying. Take care. Thank you, sir.